Hello and welcome to Core Finance. And my guests this morning are Rob Double from Core Politics and Jeremy Lyon of Hobart Capital. So welcome to the programme. Rob, let's just kick off with the sort of political things that might be affecting the markets today.
Well, the most obvious one would be what's happening with Brexit, as it always is nowadays in terms of politics. But Theresa May rushed to Brussels yesterday to try and solve this Brexit stalemate which is happening between the EU and the UK over, when has sufficient progress been made by the UK and the EU to start looking at future arrangements. So, stuff like free trade agreements with the EU and the UK, so all sort of future stuff. The sounds from it is that they published a letter jointly saying that they both agree to the principle that there needs to be accelerated progress on the talks currently. However, there was no news in terms of, actually concessions, what had been decided on, whether there had been any indication that things had actually got moving again from this stalemate. And so what I suspect to find is that the EU Commission talk later this week will say, sorry, we're not moving on to that second stage of negotiations yet because that sufficient progress margin hasn't been reached yet.
I was amused to see Roger Bootle in the Telegraph yesterday saying a no deal wouldn't be all that bad and that Jean-Claude Juncker might actually turn out to be our saviour.
Yeah.
Only time will tell.
Time will tell.
And Jeremy, we had a really important subject here today, the insurance industry. It seems very topical with Hurricane Ophelia skirting our coastlines only yesterday.
Yes, it isn't only it's storms and it's earthquakes, it's flooding, it's right across the world. It's quite amazing, and of which the insurance industry is meant to have reserves and safeties in order to help the industry through their traumas. The interesting thing is that due to excess cash, like very low interest rates and QE, the insurance industry may well have been taking on excessive risks and at low rates, because relatively the last 3 or 4 years it's been quite profitable. Now, 50 years since we've had storms like this, who's going to be left with their trunks on when the tide goes out?
Absolutely.
The other interesting thing is the industry, which is a very long-term industry, it's used to putting in reserves, it's used to getting return on its cash as the premiums are paid. And because the interest rates now are so low, they've had to take on excessive risks in order to guarantee the returns and the costs of running the business.
That quest for yield in the fixed income markets. Yeah.
And have they taken excessive risks? Now we will find out over the next 6 to 9 months.
Yes, as they have to pay their claims and liquidate their positions.
The American situation is slightly different to the rest of the world because the federal normally pays a fair proportion of their frightful disasters.
Yeah.
But there'll still be big ricochets back in the London market and the Japanese market. They like to take excessive risks too. So it'll be very interesting how it works out over the next month. Meanwhile, our market is steady as a rock.
Yes,
Nothing seems to disturb it.
And I guess that's the thing. Even in the insurance sector, the companies' share prices haven't really moved very much. It's not always when the markets are calm that they're safest, that's for sure.
Yes, sir.
Well, thank you very much indeed. Most interesting insight into the insurance industry.
Okay.